Greetings and good day to everyone. Today, Group 5 from Tutorial 1 will be presenting Entering Developed and Emerging Market from Chapter 15.
Hello everyone. So now I'll be talking about question 1A, which is about why did Tesco's initial international expansion strategy focus on developing nations? So there are mainly two reasons for why Tesco actually focused on its international expansion strategy on developing nation. First and foremost is the reduced competition compared to established nation. Those developing nations contains capable but not that strong competitors to provide space for improvement. Meaning to say, new companies such as Tesco, which is focusing on international expansion, uh, can improvise themselves and still have room to upgrade themselves without being overpressured by other competitors who are very strong. So, such uh, normal competitors are needed in order for Tesco to expand their strategy into developing nation. Besides, surrounding market and competitors have strong growth trends, which means uh, it is a basic assumption that Tesco can also have a strong growth trend as in parallel with other companies who also have strong growth trends. It's because they are all operating in under one same market or a same country, which is also known as the developing nation. The second reason is it contains companies that are easier to engage in partnership and have deep understanding of the markets. Tesco forms partnership strategy with other companies uh, that is useful in the form of bringing assets to the venture. So, they collaborate to each other to bring more assets to the venture. Whether it is liquidity assets, which helps the company to increase its value, or asset in the form of which Tesco can use it as a capital in order to generate more value. It is still bringing many advantages to Tesco and the company it is in partnership with. Besides, companies to be engaged in partnership are in same level of growth with Tesco compared to established nation. So the partnership that Tesco has done with companies in the developing nations are in the same level of growth as Tesco. This proves that there is a low level of ego between them, and both of them can collaborate very easily and productively in order to create success. As an example, if let's say there's a scenario where there is very powerful company and there's a quite weak company, it's quite hard for them to do the partnership because sometimes there would be a lot of factors such as internal factors and external factors such as ego clash, conflicts, uh, prioritize over their own companies can occur, and these can lead to huge disadvantage to the companies that is involved in the partnership. For example, in the Europe, Tesco has partnership with Global, which is a grocery chain in Hungary, by owning 51% stake in the company. As an example, in the Asia, Tesco forms partnership with Lotus, which is a local food retailer in Thailand, by owning 75% of stake in the company. So that's all for question 1A. Thank you.
The next question, 1B, would be how does Tesco create value in its international operation? So, I would like to give three main points. The first one would be unique product offerings. Tesco create value by offering products that are not widely available in the target market, addressing the unmet needs. This approach allows Tesco to charge high prices for their unique and also high quality offerings, thus building sales volume more rapidly due to the strong demand for differentiated products. The second point would be localization and product partnerships. So Tesco also commonly use local suppliers and their products by relabeling it or rebranding it to Tesco's brand. So we can say it's a win-win situation for both parties because local businesses can increase their demand and also revenue, whereas Tesco also gain a competitive edge by including products that are culturally and also regionally relevant to into their inventories. So the third point would be local management focus. What does that mean? It is basically hiring local managers and leveraging core retail capabilities. So instead of relying heavily on expatriate managers, Tesco hires local managers to run the operation. Locals who are also very good in the culture and also market dynamics. So they are also being guided by experts all the way from UK. So this ensures a deep understanding of local market dynamics and also effective transfer of Tesco's proven retail capabilities to the new market.
Hello and good day everyone, especially good o'clock. So my name is Muhammad Hafiz. I'll be discussing about the question 1C. In Asia, Tesco has a history of entering into joint venture agreements with local partners. What are the benefits of doing this for Tesco? Okay, for the first one is a market knowledge and access. Local partners bring in-depth knowledge of customer preferences, cultural nuances, and regulatory landscape, which enabling Tesco to adapt its offering effectively. Second one is shared investment and risk. Tesco can share the financial burden of entering a new market, reducing its capital exposure and risk. And the last one is regulatory compliance. Many Asian countries have restriction on foreign ownership in retail. Partnering with local entities allow Tesco to comply with regulation. Okay, for the second part of the question is what are the risks and how those risks mitigated? So the first one is the risk, cultural and operational misalignment. Differences in corporate cultures, management styles, and operational practices may lead to conflicts. Language barriers and differing business priorities can affect decision making also. So how is mitigated? Localized management. So Tesco can do this on to mitigate the risk. Appoint experienced Tesco personnel to work closely with the local team, ensuring alignment with the corporate goals, and also foster cultural understanding through training and collaboration. That's all for this question. Thank you.
For the next question, is Tesco entry into the United States represented a departure from its strategy of focusing on developing nation? So, why do I think that Tesco made this decision? First of all, because Tesco want to enter the large, mature and developed market. Because when they enter the US market, it can reduce their reliance on developing economies, which are more volatile. So the next one is they want to expand their global market share. So as we know, the US is a big market to enter. So they want to expand the experience to enter the US market. Next one, compete in the US market so they can test their product in there and to learn and improve from the other brand business such as like Walmart. The last one, why? Because offer more economic and political stabilities than many developing countries. So this stability might have been appealing to Tesco as a way to balance their risk in global portfolio. So the next one is how is the US market different from other market that Tesco has entered? Uh, like I said before, in the US market, they have highly competitive market. So there are many big brands that are more famous than Tesco. So when they enter the market, it is a highly competitive market. So the next one is more stable on economic and political. Like I said, US has more economic and political stability than many developing countries. This one, consumer behaviors and preferences, so they can test their product on what US people need and wants. The store format and size also differs. In the US, the store and size is more big than other countries, and also less on pricing sensitivity product. Uh, I think that's all for me. Thank you.
Licensing proprietary technology to foreign competitors is the best way to give up a firm's competitive advantage. Discuss. Among the several models for entering foreign markets, licensing offers the advantage of allowing the licensee to bear the cost and risk associated with opening up to foreign markets. However, there is also a disadvantage that the potential loss of technological know-how to the licensee, as well as the lack of tight control over the licenses. When a company licenses its proprietary technology to a foreign competitor, it essentially provides them with access to valuable intellectual property. This allows the competitor to use the technology to improve their own products, which can lead to them gaining an edge in the market. When licensing, the company often has to share its intellectual property, and once that knowledge is out in the market, it's difficult to control how it's used. In some cases, the licensee might even find ways to replicate or improve upon the technology without relying on the original form. This is especially true if the licensee is able to acquire local knowledge, scale the technology more effectively, or leverage lower production costs.
Alright, so hello everyone. My name is Muhammad Iqbal and I will answer question 3. So, for question 3, we need to discuss how the need for control over foreign operations varies with firm strategy and core competency. So, what are the implications for the choice of entry mode? So, the first one, we need to understand what is the need for control, which is our strategy and core competency. So for strategy, we need global standardization strategy. We can also use localization strategy, international strategy, and also transnational strategy. So for competency, we need unique technology or know-how, and we also need brand image and reputations. And the last one is integrate value chains. So for implication for entry mode, we have three level, which is high control, moderate control, and low control. So for high control, we have wholly owned subsidiaries, and also we need a joint venture, which is with major ownerships. So for moderate control, we can have a joint venture with minority ownerships and strategic alliance. So for low control, we can do franchising, licensing, and exporting.
So now let's try to solve critical thinking and discussion question number 4. So first is focus on market entry strategy. So firm is deciding how to enter and serve the EU market effectively, and the options could include manufacturing domestically and exporting, setting up local manufacturing facilities, partnering with local firms, or licensing its products to EU-based companies. Second is importance of manufacturing decisions. Manufacturing is critical due to its impact on cost structure, control over quality, and compliance with EU regulations for medical products. The decision to manufacture locally in the EU or at home in Canada involves evaluating factors such as economies of scale, logistics, and tariff implications. The last one is financial implication. The cost of setting up manufacturing facilities in the EU is significant but manageable for the firm. This implies the decision is not purely about affordability but about where the investment would yield the best return. After that, we're gonna choose which option is the best.
If these are the firm's only options, which one would you advise it to choose and why? The answer is C. For the advantages, the first one, utilize the existing infrastructure and market presence of a large European partner. The second one, faster market entry and potentially greater acceptance due to the partner's reputation. The third one, shared financial and operational risks, making it a lower cost. So in contrast to A and B, why will we choose C? The reasons are about the first one, by sharing risks and costs, the financial burden is reduced and the risk of failure is minimized. The second one, with the partner's market knowledge, distribution channels, and regulatory expertise, the firm can quickly establish a market presence. The third one, although the company loses some control, it can still make key decisions together with the partner, ensuring maximal benefit.
Here are the first 5 summary points of Vanguard in China. The first one is entry strategy. Vanguard entered China by forming a partnership with Ant Financial to leverage its extensive digital ecosystem and tap into growing demand for wealth management solutions among Chinese consumers. Point number 2, focus on low-cost investing. Vanguard brought its hallmark low-cost passive investment philosophy to China, aiming to attract retail investors seeking cost-effective investment options. The third one is digital advisory model. The company introduced a digital investment advisory service through platforms like Alipay, targeting tech-savvy users and capitalizing on the trend of fintech-driven wealth management. The fourth one is regulatory challenges. Vanguard faced difficulties navigating China's stringent and evolving regulatory environment, which posed barriers for foreign investment firms and created uncertainty in long-term operation. And the fifth one is intense competition. The Chinese market was dominated by established domestic firms and other foreign players, making it difficult for Vanguard to gain a significant foothold.
Continuing the summary points, so passive investment products, cornerstone of Vanguard strategy, face relatively low demands in China, where investors showed a preference for actively managed funds and speculative investments. Point 7. Vanguard's operation in China struggled to achieve the scale necessary to sustain profitability, prompting the company to reassess its long term strategy in the region. Point 8. After evaluating the challenges and market dynamics, Vanguard decided to wind down its retail operations and terminate its joint venture with Ant Financial, refocusing on serving institutional clients. Point 9. The case highlights the importance of understanding local market preferences, adapting global businesses models to regional nuances, and anticipating cultural and regulatory complexities. Last but not least, Vanguard's exits underscores the broader challenges faced by foreign firms in penetrating China's financial sector and emphasizes the need for flexible strategies and partnerships when entering emerging markets.
What are the attractions of the Chinese market for Vanguard? Vanguard's appeal in the Chinese market can be summarized in four key points. First, the market size and growth. China is the second largest economy in the world with a population of 1.4 billion people. Additionally, the rapidly growing middle class is driving a significant expansion in the retail investment market. Second, the increase in the middle class growing interest in investment products. China's middle class is growing rapidly, and there is an increasing interest in asset management and investment products. Particularly, investment culture among younger generations is becoming more active, and there is a growing interest in passive investing. Third, the regulatory changes allowing foreign companies to operate. The Chinese government has been gradually opening its market to foreign financial service companies. Although regulatory certainty still exists, as the Chinese government remains cautious about foreign companies gaining too much influence, these changes provide Vanguard with a significant opportunity to enter the market. Finally, the innovative approach through technological integration. Vanguard has partnered with Ant Group to leverage China's vast digital payment network and fintech ecosystem, and has over 1 billion users, providing Vanguard with a substantial opportunity to rapidly establish a presence in China. By offering innovative digital investment services such as robo-advisory, Vanguard can reach a broader base of investors going beyond traditional methods. Does it make sense for the company to participate in this market in some form? Vanguard's entry into the Chinese market can certainly be considered a valid choice. There are three key factors to consider. First, Vanguard can add significant value to Chinese investors. By offering robo-advisory services tailored to China's digital investment landscape, Vanguard has an innovative approach. Through its partnership with Ant Group, Vanguard can leverage Ant's platform to reach a large audience. This helps promote passive investment strategies like low-cost index funds, which are gaining popularity, especially among China's younger generation and growing middle class. Second, the long-term growth potentially in China is a key reason for Vanguard's potential success. With its rapidly growing middle class and increasing demand for financial products, China presents a huge opportunity. Vanguard's strategy of offering low-cost index funds fits well with this growing demand. And while stock picking remains popular, the rising interest in passive investing is a promising trend for the long run. Finally, Vanguard's approach differentiates it from competitors like BlackRock. Vanguard focuses on retail investment in China through digital services, whereas BlackRock has traditionally focused on institutional investments. This gives Vanguard a competitive edge in offering digital-first solutions.
The third part of the question highlights the risks or challenges associated with entering the market. There are five risks. The first one would be regulatory risk. So, China's regulatory environment is unpredictable, as seen with the suspension of Ant's IPO in 2020. This could restrict Vanguard's operation and also growth. So the second risk would be political risk because political decisions or sensitivity such as Jack Ma's controversial comments underlines the risk of abrupt regulatory invention. So Vanguard must carefully align with China government's policies to avoid disruptions. So the third risk would be cultural and market challenges. So many Chinese investors prefer high risk, high return stock picking strategies over Vanguard's passive long term investment approach. So due to that, Vanguard must educate and build trust to shift the customer preference towards robo advisory solutions. And moving on to the next strategy, which would be intense competition. So Vanguard faces competition from established state-banked institutions like ICBC and China Merchant Bank, as well as fintech startup, because they are all targeting the same market. Last but not least, dependence on Ant Group would also be considered as risk associated with entering the market. It is because Vanguard's heavy reliance on Ant for distribution and also operation could be risky if Ant faces further regulatory or operation challenges. So, as a conclusion, as China's investment landscape matures, the demand for financial products is expected to grow rapidly. Vanguard's strong positioning through its early adoption to retail focused strategies and smart partnership with end groups lays the groundwork for the future success. However, long term growth will depend on overcoming regulatory and also cultural hurdles while adapting its strategy to evolving market dynamics.
Moving on to question 2, which is prior to Ant's IPO being pulled by Chinese regulators, did Ant make a good joint venture partner for Vanguard? What are the benefits of partnering with N as opposed to A, partnering with one of China's large state controlled banks, or B, going it alone in China? I'd be answering the first half of the question, which is prior to N's IPO being pulled by Chinese regulators, did N make a good joint venture partner for Vanguard? And the answer for it is yes. N make a good joint venture partner for Vanguard, even though N's IPO or initial public offering is being pulled by Chinese regulators. This is because N and Vanguard mainly involved with two reasons. First is they offered robo-advisor or automated say a service to investors. So these automated services are services that has been provided via internet or online. So Vanguard and N actually offered an automated service through robo-advisor that collects potential investments. So it is an automated, which means it's an online investment that they have come up with the idea of collecting investments from public via mutual funds. So as a result, we can see that in the 100 days of its launch, it has successfully collected more than 200,000 customers that have invested more than 300 million collectively. So this shows that how people prioritize automated services in this era and they use it to their advantage. So this helps N and Vanguard that that created this automated service and provided it to gain more value and profits via this service to investors. Next, the second reason of why uh, N made a good joint venture for Vanguard is because they ventured directly into the retail market. So the partnership of Vanguard and N actually settled for being lesser partners with Chinese banks, which means they required lesser stakes compared to other companies in Chinese banks uh, in order to obtain individual investors that actually differentiates the situation with other companies. Why it differentiates with other companies? Yes, the situation is Vanguard and N does not have to necessarily manage money for China's institutions and state funds in order to create branding. So many companies, many foreign companies that actually does partnership in China, they tend to actually manage the money for China's institution, state funds, and other Chinese funds in order to make an image or name for themselves, in order to improve their growth and to increase their profits. But what did N and Vanguard did? They partnered up with the bank for lesser rate, which helped them to directly approach individual investors in China. So this is also another smart move by Ant and Vanguard, which made them create a huge value for their company. So even though uh, Ant did not get approved of their initial public offering or IPO by the Chinese government or regulators, Ant and Vanguard have successfully made a great partnership within themselves. That's all from question two, the first part. Now I will pass on to the next presenter. Thank you.
All right. So, what are the benefits of partnering with N as opposed to A, which is partnering with one of the China large state-controlled banks, or B, going it alone in China? So, partnering with one of China largest state-controlled bank was certainly an alternative for Vanguard, but it would have presented in a different set of trade-off compared to partnering with ants. So, as we all know that Vanguard partnering with ants, they came with a lot of benefits such as massive reach and distributions, technological expertise, local market knowledge and regulatory navigations, and also brand recognitions and trust. So what is the advantage of partnering with state control banks? So the first one is strong regulatory relationship. The second one is established customer base. The third one is extensive branch network. And the last one is trust and stability. But what is the disadvantage of partnering with state control bank? So the first one is lack of digital focus and agility. There are also bureaucracy and slower decision makings. There are also potential conflict of interest, and there will be less alignment with retail focus. So ultimately, Vanguard decision to partner with N reflected its strategic priority of reaching the mass retail market through a digital driven approach. So N strength in fintech, user engagements, and data analytics were more aligned with this strategy compared to the more traditional strengths of state control banks. So I think that is all from me. Thank you.
Hello guys, this is Yuan Qitai who is presenting, and now let's talk about the potential benefits to Vanguard's strategy of focusing on the Chinese retail market. So first is market differentiation. The retail market in China is massive, consisting of hundreds of millions of small investors, representing a largely untapped segment for Vanguard's low-cost index funds and robo-advisory services. By focusing on retail investors, Vanguard can position itself as a pioneer in promoting passive investment strategies, which are less prevalent in China compared to active stock picking. Second is scalability. The retail market provides Vanguard with the opportunity to scale rapidly due to the vast population and growing middle class, many of whom are seeking investment opportunities. Vanguard's partnership with Ant Group leverages Alipay's digital ecosystem, giving Vanguard access to over 1 billion users and streamlined distribution channels. Third is regulatory trends. Chinese regulatory authorities are increasingly relaxing restrictions on foreign financial service firms, creating a favorable environment for Vanguard to establish a foothold in the retail investment market. Last is long-term potential. Engaging with retail investors can create a broad customer base, ensuring diversified revenue streams and reducing reliance on a few institutional clients. Over time, as Vanguard's brand and market familiarity grow, this strategy could yield substantial returns. And that's all for my part.
Now, I'm Ashraf. Let's move on to the next part, which is the risk that the Vanguard of China might face in the United States. The first one is regulatory risk. There is a greater possibility of getting regulatory attention, particularly in such sectors as the retail market, which incinerate the interests of vulnerable investors. The alterations in government policies, for instance, of that and IPO, which was blocked, can easily jeopardize Vanguard's operational ability. Next is cultural differences. Local retail investors have higher risk tolerance and shorter investment horizons. Such a profile doesn't fit the low cost, long term type of investment product that Vanguard produces. Last but not least is intense competition. The local players drawn the retail market primarily due to their deep knowledge in the space and trust developed with consumers. Such an entity like Vanguard will face huge hostility to gain the same acceptance. Now, that's all from me. Let's move on to the next question.
Hello again, guys. My name is Hafiz. So for this question, what are the implications for the vanguards of Ants IPO being pulled by Chinese regulators? Are there political risks here? Could those risks have been mitigated by pursuing a different strategy? So the first one is for the implication for vanguards of Ants IPO. So which is investor sentiment. Regulatory actions create a ripple effects across the broader of Chinese tech sector, affecting investor sentiment and potentially leading to a short-term sell-off or hesitation in allocating funds to Chinese equities. For the Vanguard as a global fund manager would need to balance the sentiment while maintaining exposure to high growth markets like China. So the second one is the opportunities for the other investment. While the IPO pullback poses risk, it could also create opportunities. Lower valuation in the sector might allow long-term investors like Vanguard to acquire assets at a discount, betting on the recovery.
For the next one, are there political risks here? So for me, there are political risks involved because the Chinese government decision to stop an IPO show that it is increasing regulation for fintech companies. So the implication is this could pose a risk Vanguard operation in China. So in summary, tighter regulation could limit Vanguard ability to operate effectively, increase costs, and can make it harder to achieve growth in China. So, uh, the next question is: could this has been mitigated by pursuing different strategies? So, they can mitigate the risk by pursuing this kind of strategies, which is the first one. Vanguard could have diverse partnership in China rather than relying heavily on them. Next one, they can ensuring all operation comply with China regulation. And the last one, they can conduct a thorough risk assessment before entering into partnership that can help them to identify potential risks in the market.
Okay, the question is given events unfolding in China. Should Vanguard stay the course with Ant? I think the answer is yes. For the advantages, the first one, market penetration in China. Partnering with Ant helps Vanguard navigate China's regulatory and cultural challenges more effectively than going alone. And the next one, access to a large customer base. Alipay's 1 billion users, giving Vanguard access to a vast customer base in China, especially retail investors. And the next one, accelerated growth in wealth management. The partnership allows Vanguard to tap into China's growing demand for wealth management, especially among the expanding middle class. And the next one, technological innovation. Through Ant, Vanguard gains access to advanced fintech technologies such as robo-advisors and AI-driven investment tools. And the next one, brand trust. Partnering with Ant boosts Vanguard's credibility and visibility in China, making it easier to earn local investors' trust.
So, continuing the question, given events unfolding in China, and should Vanguard stay the course with Ant? So here we have the disadvantages, and one of it is regulatory uncertainty. So the Ant Group has faced a lot of pressure from Chinese regulators, and since Vanguard is tied to them, any new crackdowns could directly impact their business. Other than that, there's also less control. So Vanguard only owns 49% of the joint venture, so which means that they are not in the driver's seat. So and has the final say in major decisions which could lead to misaligned priorities. So moving on, we have reputation risk. So if Ant Groups gets into trouble, like their blocked IPO or any future controversies, it could hurt Vanguard's image by association. And other than that, we also have fierce competition in the Chinese market. So the Chinese market is packed with both domestic players and other foreign firms trying to break in. So standing out won't be easy even with Ant's backing. And then we also have cultural and strategic differences. So relying on a partner like Ant may help with local expertise, but it also comes with challenges. Differing businesses practice or priorities could slow down progress.
Hello, Doctor. Before we end our presentation, we would like to take this opportunity to thank you for all your hard work, and all your hard work have made significant impact to us, and we are deeply appreciative. Thank you again for your kindness and support. This course and for this whole semester cannot be the same without you. Thank you.